gold now, because gold is something that always fascinates South Africa and South African investors. We are maybe the fourth biggest, rather than the first biggest producer of gold in the world, but it still resonates with us every single day. The gold price was under pressure recently and it's now suddenly back to the four. Can it last? I don't know. Let's go to London now and find out with Ross Norman, the CEO of Sharps Pixley, to talk about the gold price. Ross, thanks very much for joining us. 1200 was the low for 2013 put in place just a few days ago.
It looks like it. Certainly gold's got a bit of a spring in its step this morning after the FOMC minutes were released last night. It's led to a complete recalibration of people's expectations for QE. With that, the dollar fell and gold rallied. In overnight trading, gold was nudging just close to $1,300 an ounce, still down about 25% on the year to date. But this move up, I think, has been very encouraging. There's two aspects to it. Not only the price action, but also there are signs that the cost of borrowing gold, something we haven't seen on the radar for 5 years, is going up. Now that's important because there's been a big short selling of gold over the last 2 or 3 months that has pushed this gold through key technical levels. Now those short sellers, those people who benefit from a fall in price, have got rising costs of holding that position with the borrowing costs rising. So not only is it a crowded trade, they're having to pay even more money to hold that short position. We saw some short covering yesterday. We think there may be more to come.
So what you're saying is there's an expansion of the contango. I don't want to get too technical, but with US bond yields and all other bond yields starting to rise, interest rates potentially rising over the next couple of years, the whole picture of gold, the whole structure of the gold market has changed.
It has dramatically, and interest rates play a key part in that. Typically, with higher interest rates, it's more attractive for producers to sell forward in that environment. But hedging isn't the key issue at this moment in time. It's really the impact on gold on those short sellers, and that's precipitated a significant sell-off by the ETFs, some of the weaker hands within the who are holding ETFs. So we've seen about 600 tons out of 2,800 tons of ETF selling in the year to date. So to a large extent, I think the bad news is already in the gold price today. Are we about to see a significant rally? Too early to say. We seem to have found ground out a bit of a bottom here at about 1180 on the fall before establishing a base, but certainly looking ahead. The only bit of bad news on the horizon at the moment is India. The government seemed hell-bent on waging war with India to resolve its current account deficit there, and the expectations are that Indian imports will roughly halve during the course of the balance of this year. And they are, of course, the world's biggest gold importer. That's the bad news. But what India's loss is China's gain, because they're challenging India for the top position, are doubling their gold imports. So it's pretty well netting out across the two.
Ross, from your website, it's quite clear that the consumers in Asia, who are usually a very good indicator, are trying to pile into gold. As you say, in India, it's a bit more difficult for them at the moment. How good an indicator has this been over the past few years?
Well, it's interesting actually, the difference between the two principal buyers. The Indians, we use this horrible term bottom pickers. In other words, they look for markets which are rounding out, looking to find a bottom. The Chinese, on the other hand, have a different mentality towards buying. They look to see what's exciting and new. They typically buy at about the same price. One on the way down, the Indians, one on the way up, the Chinese, roughly at the same level. But so there's a very different psychology to when they buy. And I think actually the fact that the Chinese are buying is a very constructive sign for gold. You might suggest that you might infer from that, of course, that Chinese are bubble creators. They follow what's exciting and drive it to new levels. Certainly they're into the gold market in a very, very large way. But it's not just China, of course. In Dubai, there are physical shortages of metal. Premiums are going through the roof. And even in Europe, where we have less of a cultural affinity for gold, I should say, there's signs of very good, strong buying. So premiums, again, in Europe rising very high. Interestingly, the physical is red hot. The futures is the area where we've seen the weakness. So for the first time in a long time, we've got this very strange dynamic between two markets.
Ross, I'm going to cast a pall on this enthusiasm. I love gold. I want gold to go up. I don't like the fact it's come from 1900 to 1200 essentially. But what really worries me for the future is that any rally might be capped, because all those gold mining companies that have lifted their hedges over the last few years and propelled or helped propel the price go higher might say, well, goodness me, if we get back to 1400, 1500, 1600, we're going to reinstate those hedges and therefore the cap might be in place.
And particularly with the wage claims going through at the moment, that might be particularly in chief executives' minds. Certainly we'll know if that's starting to take place, because you'll see the costs of borrowing gold edging higher as more and more producers hedge. To date, very, very little hedging has taken place. I think, though, that fundamentally chief executives of the major mining companies remain buoyant and positive for the long-term outlooks for gold, notwithstanding QE. Let's remember that this gold bull run preceded this economic crisis by 5 years. The fundamentals remain very positive. It is also, of course, a lifeboat in a crisis, and of course safe haven buying continues. There could be some hedging. I would doubt it, though. I don't think it would be very significant, if not least of all the owners of those mining companies, the shareholders, after all, don't want it. They want to have a run on the gold price through these mining shares. So I think any miners thinking to do so would think probably twice about doing so. It wouldn't be popular.
Ross, ahead of this discussion, I went through my library and picked up a book that my friend David Shapiro had given me. There we go. It's The Power of Gold, written by Bernstein. I'm not sure if you've had a chance to read it yet, but he does Bernstein in his conclusions, to Marco Polo, going back way into history and talking about Kublai Khan's currency. Now, anyone with a knowledge of Chinese history will remember Kublai Khan did quantitative easing on quite a heavy level, and of course the whole pack of cards collapsed. Why are we not looking at that as those of us, and I hear Lindsay's in the other side of the camp, who have a view that gold will hold, or at some point in time return to being a good store of value?
Well, I think it does, and I think what we're seeing at the moment in the fall of gold by roughly a third from 1922 to the current levels is predominantly speculative activity. And the futures trading that takes place in New York, it's tidal, it's tribal. I hate to be unkind, but the traders are like teenagers high on E-numbers. They love gold, they hate gold. It changes day in, day out. In the long term, it doesn't matter. For the long-term investor, for the real long-term investor, they look at the fundamentals. They remain attractive. Gold is below the total cost of producing for 1/3 of the mines. It cannot be sustained. For long-term investors, they also know that gold retains purchasing power parity. Gold has essentially done its job over this economic crisis. You've probably heard the apocryphal tale that an ounce of gold in biblical times bought you a suit of clothing, the same in Tudor times and the same today. An ounce of gold is, of course, $1,200, a nice suit of clothing, albeit. But the key point is it maintains its value. And in a world where maintaining value is of importance, I think those investors know that. So I don't think that they're spooked by this very sharp price correction. And I hope that mining leaders listening to this will also take note of that and also consider that gold has a long way to go. It really does maintain its value.